All right, welcome, ladies and gentlemen. Thanks for taking the time to join us here this evening. My name is Josh Asher. I'm going to be the presenter with Tesseract Asset Management here. Real quick, want to thank everybody for taking the time to join us and watch the presentation. Tonight, we're going to talk about the risks that are out there in the market. There's obviously a lot of headline risk out there, a lot of pundits on TV saying a lot of different things. So we found it important to take some time and address them and really talk a little bit about the risks associated, but we don't want to get caught up in figuring out how to solve the world economic crisis. What we want to do is help you understand from more of a macro view what the playing field could look like over the next 4 to 6 years with some of these risks that are coming into our lives, and try to understand the best way to play the market. I mean, let's face it, with fixed income markets where they're at and the yields with interest rates near zero, it's very difficult for investors, especially investors that are nearing retirement age or already retired, because a lot of the traditional models, as we'll look at through the presentation, just don't work anymore because you can't decrease that risk with age, kind of that golden rule anymore. The risks in the stock market now are a little bit higher. Obviously, the yields in the fixed income market aren't worth sitting in, so your choice is to go into cash or play a little bit more risky stock market. So these are big decisions, and when making these decisions, it's important that you understand these decisions. Something we say all the time at TAM: education breeds confidence. Confidence breeds conviction. Conviction is the only metric by which you should make those decisions. So if you don't have conviction in what you're doing, if you don't have conviction in your portfolio, if you don't have conviction in your positions or your allocation, you really need to take some time to understand, educate yourself so that you can have that conviction. You'll sleep much better at night, and you'll be able to look at things a little bit more clearly. So let's go ahead and get going. One of the things that I want to address real quick is uncertainty. A lot of people think that because of the pigs, Portugal, Italy, Ireland, Greece, and Spain, that the markets don't like bad news. The market doesn't mind bad news. Matter of fact, the market likes any kind of news that it can measure. It likes any kind of news that's real. What it absolutely hates is uncertainty. So when I read a headline, like actually I just read before I started the video, it said EU leaders are going to set a timetable. Again? Really? I think I've probably read that headline 15 times in the last year, because we all remember this entire debt crisis started back really in August, kind of September, July of last year. And what you're looking at here is a chart, the Dow Jones, and the highlighted box is the period of time from last August through kind of mid-November. And we measured that period of time, and it was the largest volatility or standard deviation, the largest amount of volatility for the most amount of time, for an extended period of time, that this market has ever seen in the history of the stock markets. That right there is uncertainty. That right there is kicking the can down the road. It's not having a plan, not understanding the sovereign debt crisis over there. And it's really different. I'm not going to get into it all because that would be an entire other presentation. But the main thing that I can say is that liquidity does not fix insolvency. They're two different things. And we can try to be more liquid, and we can try to get that zero interest rate credit card to transfer our balances to, so we don't have to pay the 15% and get that introductory rate for 6 months. But eventually, we're going to have to pay those balances. And that's really what's going on right now over in the Eurozone. And I guess it's really what's happening here in the homeland. So I guess those that live in a glass house really can't throw too many stones. Another issue that's coming up here is China. Their GDP is starting to slow. Now, this is a little bit less of an issue because their economy is still doing pretty well. nevertheless, it is headline risk. It's out there. People are making decisions based on it. And of course, anything that slows down has to start somewhere. And I guess the question a lot of people are asking is this it? Has China's GDP peaked? Has their economy peaked? Have they financed too much of their building with debt? And do they have the ability to pay back that debt? And again, like the Eurozone crisis, I definitely don't have the answer. So moving a little bit closer to home here, the debt ceiling, I just love this cartoon, but the debt ceiling here in the U.S. is going to be even more of an issue. And if you guys remember talking about kicking the can down the road last July, we began talking about the debt ceiling, and of course there was the infamous congressional fumble where we were deadlocked, and they had the countdown ticker on CNBC, and the pundits all had, this was exciting stuff, and people were making massive decisions based on this. And it just goes to show you that when it's kind of said and done, like the Greek elections, they built this thing up so big and so massive that you thought the market was going to gap open the next day by 10% or gap down by 10%. And at the end of the day, what happened was it was a non-event. Nothing happened. Except for CNBC and MSNBC and CNN got phenomenal ratings throughout the crisis. So really, it's important to kind of take that step back sometimes. But adding to this budget deficit is the fiscal cliff. Now, a lot of people in here may not have heard of the fiscal cliff, but this is something that's going to be more of an issue moving forward. By the way, this does stem back to last July, and even previous to that, the fiscal cliff stems too. But of course, we're going to wait because we are coming up towards an election year, and we don't want to have any major issues affecting us. So we're going to try to have some secret meetings. They've tried to have some secret meetings on the fiscal cliff, which, by the way, aren't so secret if we know about them and a lot of other people know about them. So the fiscal cliff, for those of you that don't know, is basically what it describes, what that term is. And I always find it kind of funny because on Wall Street, anything that affects the street has to have a name. It's kind of like a dog tag, if you would, that says, well, we're going to call this a fiscal cliff. But that fiscal cliff is basically a mandate for an indiscriminate and very wide swath of spending cuts by Congress. It includes everything from Medicare pay for doctors, pay to the unemployed, come 2013, so there's going to be some unemployment subsidies that are going to be running out. And one of the biggest issues is a lot of the tax breaks that the Bush administration put in and some that the Obama administration put in to help stimulate the economy and add a little bit more disposable income to the consumer, because we're a consumer-based economy. Some of those are going to expire. Actually, a lot of them are going to expire. And the two dates that you want to keep in mind is December 15th and January 1st. Those are really the two biggest dates for this issue right now. I'm sure we're going to find ways to kick this thing down the road a little bit, but what we're talking about is $700 billion, or even more, possibly. That's kind of the number that a lot of people are talking about. And of course, that's if everything came at once. In other words, that's if nothing got done and everything happened at one time. We would look at the possibility of a fiscal squeeze on the economy of about 4%. Now, for those of you that aren't familiar with what that would do, and we'll look a little bit at it, but back in the 1960s, we saw a fiscal squeeze of about 3.3%. So it isn't like we haven't been down this road before, and it's important to understand what these issues are, and they're definitely not going away, but it's also important not to make major decisions based on these issues, because as we've learned from last July with the European debt crisis, it can take years for these things to work out, and a lot of times they are massive events, but from the day-to-day aspect or the week-to-week aspect, as we're going to take a look at today, they kind of get lost in translation, I guess, if you would. So as we continue to kick this can down the road, it's important that investors understand the risks that are associated with investing in today's environment. And what we're going to do is take a look at our 100-year market theory, which has really been our North Star since the early 2000s when we published it, and even earlier than that since we started using it. And it is what we believe is a better way of investing and looking at the world. It allows you to take a 30,000 foot view, see the forest through the trees, and put things into perspective. So the theory's premise basically states that excess market valuations, due to extreme price movement upward over extended periods, may take years to wane as earnings catch up with prices. What that means is these periods of chewing off or consolidation, you'll notice down here, and I'm not going to go into the entire theory because we have a video on it on our website, investtam.com. Just click in the video section and you can see it. It's about 30 minutes long, but we actually explain the entire theory. From a very broad level for today's presentation, what you'll see is down here, if you can see my cursor, you'll notice that we have a price to earnings that's a smooth 10-year, and when that goes below 10 and breaks, you'll notice we start the next secular bull market because the excess valuations that were made up during the previous bull market. So from 1950 to 1966, the market got very excessive. The valuations were very excessive. And then some events happened, a fiscal squeeze here in early 1960s, mid 1960s, 3.3% was a major part of this bear market here. Among obviously the oil embargo and the hyperinflation of the 70s and all kinds of events that were going on during this time frame caused us to chew off these excess earnings, and when they got chewed off, we saw the next bull market. So what we're going to do today is we're going to look at these channels, and we're going to decide what kind of game are we actually playing here. What field are we on? Now that we know the field, we need to understand what the rules are, where the halfway mark, where's the 50-yard line, how do I get into the end zone, and we can better game plan for it. Because what we don't want to do is we don't want to do what we've done in the past. And I talked a little bit earlier about the golden rule, which basically what that states is that as you get older in age, your risk profile that you take in the markets is going to go down. Unfortunately, there's not a lot of people, especially retirees or people that are nearing retirement age, they don't have a lot of choice with the fixed income market where it's at. The returns just aren't there. So they're forced to make decisions to go into cash and, try to ride this thing out or get into the stock market, which obviously has a higher degree of risk. So that old golden rule of investing in that asset allocation model, I'm not saying that they don't work. They have their time and place, and their time and place was a period of the markets like this from 1982 to 2000, which, by the way, the majority of those models that are in use today were built during this period. And it doesn't take a rocket scientist, no pun intended, rocket man, to look at this chart and see that in this bull market, something that works in this environment probably isn't going to work in this environment. Again, I have no problem with asset allocation models. I just believe they have their time and place in investing. In today's marketplace, as we found out 2003, 2008, as we're going to find out moving forward, you've got to be much more nimble. You've got to be dynamic. And you've got to be a little bit more active. Unfortunately, it's true. Or it's been true thus far, anyway. So, during this period of excess in 82 to 2000, a lot of these models were built. Obviously, mutual funds just exploded. More wealth was created in the market than any time in history before. And, we were off to the races. And then 2003 came, and we know the story from there. So we're going to talk about the lost decade of the 2000s, as some people coin it today. And in order to do that, what we're going to do is start back here in 1906, and we're going to look at every single one of these channels. And before we do that, we've got to identify what some of these halfway indicators are. So back in 2007, we went through this theory, we tore it up, and we did tons of research. And in that research, we found an idea to know about where the 50-yard line is. And then we found out some similarities that were eye-opening of what the second half of that field looked like. And of course, we have adjusted our strategies to that moving forward. So some of those halfway indicators include, usually it's the deepest sell-off within the channel, and it's usually the second bear market. But we can confirm that because it's always followed by the greatest bull market in the channel. And we know that that greatest bull market, with the amount of positive emotions that investors feel, usually creates a break topside of the secular channel resistance. That's what SCR means. And if you think about this, this is basically the 2003. Let's go back in time a little bit. So from 1982 to 2000, we saw the greatest rally this country's ever seen. The market ripped. People made gobs of money. Life was good. Things were going awesome. The great 80s, the 90s, couldn't get any better. And then 2000 came, and this little thing, the tech bubble, got in our way. Kind of popped the economy a little bit there, and we saw a sell-off. And in that sell-off, people said, oh, stocks are cheap now. Values, oh, the value players jumped into the market. This is the psychology behind it. People said, this is it. This is a great buying point. We're going to buy in here. We're going to buy in at these lower levels, and we're going to ride this next wave. It's going to be massive. It's going to be like it was. It's going to be great. And the recency bias that investors have got in the way. And they forgot about 2003. They didn't think to look back any further than 1982, because this is how it's been, and this is how it's always going to be, and it's going to be fantastic. And then from 2004 to 2007, for 3.5 years, things were hunky-dory. Things were great. People were making money. We had a nice bull market. And then 2008 came. And after 2008, obviously, it's a very painful time. A lot of people lost a lot of wealth. People started scratching their head and saying, maybe it is different this time. So it's that type of psychology, and the reason I say that is not to bring back out the pain that everybody felt, but it's important to look at the psychology of the marketplace. And by understanding the psychology of the marketplace and why people do the things that they do, we can get a little bit better idea as to what we have moving forward. So the second half channel similarities, once we know we're in the second half, we need to say, hey, what can we expect? Are we going to see massive sell-offs, massive volatility? What's going to go on? Well, what we found these similarities is to be shorter cycles. So the time frame of the trends aren't as long. So again, the whole nimble thing comes in. The good news is we do believe there's going to be smaller downturns. We don't think we're going to eclipse the sell-off of 2008. We think that's the worst it's going to get. The frustrating news is that there's going to be a channel inside of the channel towards the end, and these channels can be very large. They can be 12 to 18%, and they can last from 2 to 4 years. So just take this year. We went up 12%. We went down 12%. Up 12% in the first quarter, and these are just kind of averages here. Up 12%, down 12%. Well, let's just do that for the next 3 years and see how frustrated everybody is. Could be on the horizon. Let's take a look. First channel, 1906 to 1924. You can see we've got our halfway point. We had a massive bear market. It was the lowest sell-off there. And we confirmed that because we had the highest bull run in the channel. We've seen a pop topside of that market. That has to do with that investor psychology like we talked about. They enjoyed this massive run previous. Had a couple little painfuls. They got up here and they said, oh, we're at all-time highs. We're off to the races. Fortunately, those excess valuations weren't waned off. So they did have shorter time frames. In other words, the trends weren't as long. Sell-off wasn't quite as deep. The pain wasn't quite as bad. However, the frustration was as high as it's going to get. You had a cyclical channel towards the end that lasted just over 2 years. And if we look at the second secular channel, and this one isn't quite as symmetrical because of the Great Depression. And we do have, though, the second sell-off is one of the largest. We confirm that because we have the largest bull market. That bull market, again, the psychology created the we're off to the races, let's have some fun. Fortunately, the earnings weren't waned off. We have a little bit smaller cycles. This one isn't quite exact, hence the wavy line. And obviously we see a massive consolidation towards the end, and the sell-off here in this case wasn't near as deep. And again, it goes back to the Great Depression. So there was still a lot of stuff being felt here, and obviously some wars going on. But that's that channel. Here's 66 to 82. This one you're going to hear a lot about. A lot of people like to talk about this one and reference it. Again, halfway point, have our deepest sell-off. That is followed by our greatest bull market. we see a pop topside. We have smaller trend cycles in this instance. We don't see a sell-off quite as deep. Again, I mean, it's still deep, 28 and 25%, but it's not quite the 46 that we felt in the middle. And one of the most frustrating parts is the cyclical channel. Now, in this case, you had a cyclical channel of about 10 to 12% that lasted for 2 years. Then you had a pop topside, and you had another channel of about 12% that lasted for a year. And then you came back into your other channel, and that lasted for about another year. So for a combination of 4 years, you had nothing but channel trading. And if you didn't grab this pop right here this 1 month, then you missed out on the entire move. So the frustration that could be coming forward, and now you can see why the ability to be nimble is going to be so much more imperative moving forward, and really the dynamic portfolios out there. So here we are. Here's where we are today. People always ask, well, where are we? Okay. Well, we believe that this is the halfway point. We believe that because we have the largest bear market in the history of the stock market, by the way. Cyclical bear market. People are going to say, what about the Great Depression? That was secular. We have the largest cyclical bear market in history. And of course, this is followed by the greatest bull run in this market, the massive exuberance. Hey, we're almost at all-time new highs. Let's get in and ride this thing off. 8 years previous brings us to about 2016, 2017. And in that time, if now is any repeat of history as it's been over the last 100 years, we should see or plan on seeing shorter cyclical cycles. We don't think the downturn is going to be quite as deep. It's still going to be there. Could be around 840, 850 on the S&P. And towards the end, we're going to have a cyclical channel that's going to just absolutely make you want to pull your hair out. So what all of this means to investors, and everybody always asks, is it different this time? I don't know if it's different this time. They say, well, we're more productive now with technology than we ever have been. Okay. My answer to that is, again, I'm not going to pretend like, we're smart enough to answer how productive we are versus, where it was, through the Industrial Revolution, the advent of the automobile. But if I told you to go back in time into the 20s during the assembly line era and the Model T, and think that with the invention of the car and really the invention of the assembly line and bringing mass transportation to people, which allowed the sprawling of suburban America, and it allowed the transport of goods and services around the U.S. and eventually around the world. If you went back in that time and asked people if they were more productive now than ever been, is there anybody going to be more productive? What do you think their answer would be? I don't know the answer to that question, but I bet you they would say, yeah, we're more productive now than ever. So my point is, there's periods of time that I think as humans, it's just our nature to believe that we're the best now than we ever will be. So, I'm not going to argue if we're productive. What I will say is I'll leave that argument for the pundits and I guess the scholars. They can figure out which is more productive. What we're going to do, and what I recommend everybody do, is to manage your money based on risk and arithmetic metrics. And by doing that, you can continually triumph over emotion. And that is going to help you create success longevity. Do not manage your money with the returns on optimism. And that's what I'm going to say. So, whether it's different this time or whether it isn't different this time, I don't know. We've looked back on over 100 years of history, and I think it's pretty clear with what could happen. So if it is different this time and this thing rips through the top side, hey, I want that just as much as everybody in here wants that. But we've got to be real about this. What is the plan if it doesn't do that? Because if it does do that, things are easy. Things are easy. We'll run right back into these asset allocation models. Life will be good. We'll be productive. The world economy is going to just pick right up. We're going to get footing. Everything's going to be great. But if it doesn't, what are you going to do? So hopefully today helped you shed some light on what you may have planned. If you have any questions, give us a call at the office, 1-877-929-1510. Whether you're a client or not, our purpose, our passion is to educate investors out there. As such, my counterpart, William Goldenberg, is going to be doing more of these videos. on a weekly basis, much shorter in duration, maybe 2 to 5 minutes, just little snippets of things that we believe is important that you need to understand. So if you want, follow us on Facebook, Twitter, YouTube, and come back to the site. So guys, thanks for your time, and enjoy your evening, and we'll see you guys next time.